Each one of us has a different tolerance to risk when it comes to investing. So what I would like to do today is walk you through an applicable example of real stocks and look at a stock that's quite volatile and it has a lot of ups and downs, and then look at a blue chip stock which is much more stable and discuss some differences when it comes to investing. Hello everyone and welcome back. For those of you who do not know me, my name is Alex, and on this channel I talk about psychology, and sometimes I also make videos like this one in which I talk about finance and investing and how you can apply psychology to it to make better decisions. So in today's video, what I would like to do is look at the real world example of risk aversion and how that applies to the stock market and investing, and how risk aversion influences how we decide to invest into one stock or another. Okay, so the idea behind risk aversion is that most people would try to avoid risk whenever possible. An example of this is that most people would rather have a stable £50,000 a year as a salary rather than having, for example, this year 25,000 and next year 75,000 and the year after that 50,000. This is why entrepreneurship is so difficult for a lot of people. When you're trying to start a business, you will have a lot of uncertainty and you might not have a stable income, meaning that in the future you might make a lot of money or you might make none. So now let's look at how risk aversion applies to the stock market. So the first stock that I would like to talk about is PepsiCo Inc, ticker symbol PEP. If we're looking at the PepsiCo stock over the years, I put it all the way from the 1990s, what we can see is that it had a nice steady growth in the past 2-3 decades. And even looking shorter term, in the past 10, 5 or 1 year, we can see that it has still grown. And what we can see is that even during the last year, there has been a 3.5% growth on this stock. If it wasn't for the big gap in February because of the Rona situation, probably the growth would have been higher. And if we start looking, for example, in the past 5 years, we can see that it had a growth of almost 50%, starting at about $95 per share and going up to over $140. This is the advantage of investing in a stock that's been around for a while, that you can see how it's been going, and it had its ups and downs after 2018, for example, now in 2020, and probably same in 2008 when there was the crisis. But overall, you can see an upward trend in the stock price. On the other hand, let's contrast the Pepsi stock with the Virgin Galactic one, ticker symbol SPCE. So we can see is that this stock has had a lot of ups and downs, and its peak reached last March, getting up to $37 per share, and then it went back down to almost $10 per share, then up again around mid-year to 25, down again, up again a few months ago to 34 almost, down again, and now finally it went up again because of some recent news of being included in a space ETF. So all this being said, everything being considered, you would have been in general better investing your money in Virgin Galactic over a year ago rather than in the more stable Pepsi stock, as Pepsi would have given you a profit of about 3.5%, while Virgin Galactic would have given you over 130%. And the question that I would like to ask you is, if you would have to choose which one of these stocks would you rather invest, let's say $100 in or $1,000, which one would you pick? Most of you will probably answer Pepsi because it's a more established company, it existed for a long time, and it had a stable growth over the years, and it's something that you feel more confident with because it doesn't have a lot of volatility. Now, volatility per se is not a bad thing. For most of us, we're not feeling comfortable with knowing that tomorrow we might wake up and our Virgin Galactic stock might be down 50%, which has happened in the past. Most of us want to be able to sleep at night, and we want to be emotionally comfortable investing in a stock and not have to stress about it. And this is what risk aversion is. Risk aversion states that people simply prefer smoother returns over time. And volatility is the primary metric that we utilize to understand how risky a stock is or it isn't. And that's why most people would prefer investing in Pepsi rather than Virgin Galactic. Risk aversion is also why most insurance companies exist. 99.99% of us will never have to deal with a fire in our house or a flood. But most of us will invest in insurance for our house because we just do not want to carry out the risk of having that happening. And the same applies to lotteries. We know that is pretty much almost impossible to win a lottery. But the price that we're paying for the chance of winning something so big is relatively small, which makes us want to take that risk and buy a lottery ticket and hope we're gonna win. To conclude, people like taking positive risks, such as buying a lottery ticket in order to win the big prize, but they try their best to avoid negative risks, such as losing all their money in the stock market or losing their house to a fire. This is what risk aversion is in a nutshell, and why you should be aware of it, and why you should try to minimize its influence as much as you can when you're investing in the stock market. Thank you so much for watching, and I will see you on the next one.